Well, good afternoon. Hope everybody can hear me out there in internet land. Yeah, and there's Shannon stuck in St. Louis on our way
We're in
back to the Bay
California
Area.
now, but we're in Orange County.
So let me just set this down.
I'm gonna mute because it's probably background noise.
So this year's mid-year outlook might be a little more boring than last year, but I'm sure you're all pleased to hear that. Last year at this time, we were trying to figure out the next moves, both for business, how global governments would respond to, the historic challenge of the virus, and also to the impacts to worldwide commerce, most of which we're still working through. So today I'll have some, good news to pass along, but also, obviously address the challenges that are still remaining. And I'll try to be brief and cover the highlights. Certainly, if you have any questions, you can always drop me a line. And the material that we're drawing on is really produced by LPL's research department. So they do a mid-year outlook every year. And this one's called Picking Up Speed. So there is a hard copy available, brochure. If you want to read through that, just let us know. So the U.S. economy powered forward, faster for the first half of this year than really anyone expected, and the overall economy globally remains sound, and so that's been supporting strong corporate profits, and we expect it to continue, here into the future, which means potential stock market gains as well. But the pace of the reopening really created some new hazards, and that really is the biggest impact to supply chains, getting goods to where they need to be. And along with that, with both the tight labor market and government spending, which we'll talk about, we see inflation heating up. Now, the government says that's temporary, but we'll have to see. My personal feeling is that spending is going to lead to some longer term inflation as well. So one of the biggest reasons, or maybe I should say 3 trillion reasons why the economy recovered as quickly as it did, was the massive federal spending and ballooning of the money supply that we saw. In fact, there's a statistic out that 40% of all the US dollars in circulation right now were printed in the last 12 months alone. Now, the good news is that 2020 saw the deepest recession since the Great Depression, but it was also the shortest recession on record. So that stimulus, kicked us right back into high gear. This chart is courtesy of Goldman Sachs that I just got yesterday, and I thought it was, quite compelling. It shows that U.S. equities have been up for, have not seen a 5% downturn in the last 184 trading days, so half a year. That's the 15th longest period on record without a meaningful pullback. And the average overall this time is 97 days, so we're about double that. So it just means that we haven't seen any extreme volatility, that we've been, a long-term trend here for the first half of the year. So, we have to credit these remarkable teams of scientists that created and distributed, several vaccines in record time. And along with that, business, made great strides towards full reopening, some of which we may be, going back to masking and some other business things. but we'll see. So the forecast for US GDP growth is in the range of 6.25% to 6.75%. That's LPL's forecast, maybe slightly higher than some other economists. As I mentioned, last year we saw a 3.5% drop in GDP, which is the worst since the Great Depression. And while we haven't forgotten it, we put it behind us in a hurry. Now, globally, Europe, Japan especially have been slower to move past the pandemic, but we do expect strong growth when they start catching up. And then we've opted to include emerging market equities in our growth portfolios. We think they're a good source of solid growth, and several Asian emerging market countries have been the first to recover from the pandemic. So we do see that as both a growth play, and valuations are under those of the US, which we'll also talk about here in a minute. As I mentioned, the economy kind of surprised everyone here the first part of the year. And so we may be on track to experience one of the best years for growth ever. Of course, coming off, some of the lows of last year. And most economists think we probably peaked here in the second quarter, but plenty of momentum left to extend growth, through the rest of the year and into 2022. This chart shows how long expansions last, and since World War II, the average is about 5 years, but you'll see the 4 most recent cycles are even longer. And coming out of 2008, we were in an 11-year positive run, and probably would have gone on even longer if COVID hadn't hit. So we don't expect this cycle to continue as long as the last one, since it wasn't your average recession. And we've also had this huge stimulus, which obviously won't last. And then because of the way this particular recession hit, it didn't work off imbalances that we'd see worked off in a normal recession. So things like corporate debt levels remain high. Obviously, we've got extremely low interest rates, and the Fed's kind of committed to keeping those low for quite a while. And as a result of that, stock valuations never really reset. So we do think that the growth cycle probably would be at least average. And in this case, average would be a good thing, because that would be another, 4 years. Now, we think there could be, more years of weakness in the US dollar. It's been declining. And that's really a result of, 2 deficits, the budget deficit and then also foreign trade deficit. So that may just put a pressure on the dollar to fall, which could actually, be beneficial in terms of trade, but travel and expenses, if you're going to foreign countries, that'll obviously be a higher premium. So all that, good news, bad news, in the spirit of the Olympics, and my own personal bias for running and investing, is just want to reiterate that, the economic recovery is not a marathon. I mean, it is a marathon, not a sprint, and not to get, overly excited about short-term investing, even though this year's been quite good to us. So most of the, economic recovery was due to massive government efforts to keep the economy speeding along. And policy still matters, but it probably will be less important over the rest of the year. We still are anticipating some further government spending. Biden's got his Build Back Better initiative. But even if that gets passed, we're looking at spending that's probably spread out over a decade or so. Bigger risk would be around taxes. and a lot of proposals out there in negotiation right now for business and wealthy households facing a higher tax burden. And so, some of those tax proposals, and we went through this in more detail in our tax webinar a couple weeks ago, raising corporate taxes. Right now, President Biden has proposed raising it to 28%, but we think, that's negotiating may end up to be more like 25, and that's still, one of the lowest tax rates in the past 70 years. So it may be already baked into the cake. It obviously would be a direct hit to corporate earnings, but probably could be absorbed fairly easily with, as much as the businesses are seeing an increase in their corporate profits right now. And there are some proposed household tax provisions raising the top bracket from 37 to 39.6. And again, there's been much higher rates in history. And we're also talking about those earning $1 million or more. So if you're in that category, certainly give us a call. We can talk about tax strategies, but kind of a fun statistic, only 0.32% of the populations makes more than $1 million a year. So 99.68% of us won't be affected. So let's look at the crystal ball as far as we can see. And these are, LPL forecasts for stocks, earnings, treasury yields. So we see, additional gains for stocks. Now, LPL's forecast for year end is on the S&P 500 index is 4,400 to 4,450. It's up another 32 points today, and so it's already at 4,416. So not much room to grow. But this is what we've seen for most of the year, is that forecasts just keep getting raised and raised. And so, that number comes from the forecast for S&P 500 earnings, and then doing a multiplication of what they believe the earnings are worth. So I think more importantly is the U.S. Treasury yield would see an increase to 1.75% to 2%. And that's going to be critical for, bonds if we see an interest rate increase, and we'll talk more about that. So this chart shows first year after a recession and second year, and you'll see that, in most cases the second year is a little slower growth, but still positive. And so that's the good news, is forecasting, about a 13% average would be still pretty significant growth. And also the average drawdown, the yellow bars, is just a hair under 10%. So, always an expectation that there's risk in the markets. We could see a 10% downturn, but still come out of it with positive growth for the year. So we expect corporate earnings to keep rising, and earnings are continuing to rebound, and estimates again have risen significantly. So what many times causes the stock market to go up is analysts will make their forecast for what earnings will be, and then it's the surprise on the upside is companies report earnings better than what's expected. Now the S&P 500 we use as an index because it represents 90% of the stock market in terms of capital's total value. It's trading at a forward PE of about 21 times, and that's significantly above the historical average of 17. So we do get a lot of questions about, is it overvalued? It is, except that if growth continues at the current pace, it'll grow into those earnings. But there's certainly some, downside risk. And so, as always in stocks, we've got to accept that. Now, fixed income this year got off to one of the worst starts we've seen. And returns might not get a whole lot better from here. Their interest rates are very low on most everything. And we don't expect rates to move significantly higher, maybe slightly higher. But if they do move higher, that's where we see downward pressure on bond prices. And we're looking at, using bonds for income, but also total return. We don't want to lose value just to get income. So we're not giving up on high quality fixed income. Treasury securities historically have been the best, defense in times of equity market stress. But we have diversified out possibly, well, even more than we typically would, including using some different types of fixed income strategies. So I like this little cartoon here is, U.S. consumers saying, "Did you hear something?" No, it's just the wind. This talk of inflation, and you've all seen it in consumer prices in terms of food, travel, energy prices, all going up. But are we seeing it in interest rates? No, not yet. But inflation is really, bondholders' big nemesis, that it erodes the real value of principal and interest payments as costs go up, and makes those fixed income payments worth less over time. So what does that mean for core fixed income returns? Rising treasury yields are a headwind for core fixed income. And so we expect to, have low or possibly even negative return on, certain segments of the bond market. So the way to read this table is that if interest rates don't change at all, then the index is projected to return around 1%, and that's just the aggregate bond index. It's just one particular type of bond. But more likely, as we see interest rates rise over time, and if interest rates rise, we could see, prices go down 1.5% in the next 6 months to a year. So we've got to watch out for that. So how do we invest in this type of an environment? Certainly reducing the interest rate sensitivity in the portfolio, and this is where we've started employing treasury inflation protected securities, or TIPS, but will protect the principal value of the bond if interest rates go up. Also, mortgage-backed securities don't tend to have as much upside, but they are more stable in this type of environment. And certainly, not abandoning investment-grade corporate bonds, shortening up the maturity or the duration on those, so we don't see as much downside. And then there's kind of credit-sensitive sectors like bank loans, preferred securities we like, and possibly emerging market debt, although we've got to, watch currency risk there as well. So, if we're expecting low yields or possibly even, losing money in certain types of bonds, why would anyone want to own bonds? This is always the question in a balanced portfolio. And frankly, it's in case something bad happens that causes the equity markets to sell off. Plus, we collect income from those. But it's been the best diversifier to equity market declines, and a place to draw from when we rebalance in the face of, stock market volatility. So, looking out over the rest of 2021, it seems like the worst of the hard times are behind us, and we want to take some time to enjoy this long ride after a period of caution last year. But these are also the times when planning is most effective. So we want to emphasize, here we are early in an economic cycle, the next recession possibly years away. It's just a great time to sit down and make your plans and figure out how to meet them. So that's it for today. I'll wrap up and say thanks for joining our mid-year outlook. And you can have fun reading these important disclosures. And as always, let us be your guide.